Let me first begin by introducing the VIX Market Timing Module. The VIX CBOE Volatility Index was developed by the Chicago Board Options Exchange in 1993. It has since evolved into the world's premier barometer of investment sentiment and market volatility. The VIX falls within the category of so-called contrarian indicators. It tends to move between well-defined ranges, which change over time. Whenever the index reaches the top or bottom of that range, it is a reliable signal that a change in trend for the market is imminent. When investors are running scared or feel a high degree of uncertainty about the future trend of the market, they tend to pile into put options, bidding up their premium, which coincides with spikes in the VIX index. The opposite is true for bullish periods, when there is less fear, and the investing public feels less need to buy puts. Such periods coincide with lower VIX readings, suggesting complacency. By monitoring the behavior of the VIX and using it as a gauge of investment sentiment, alert investors can position themselves ahead of the crowd and anticipate when market turns are likely to occur. There are several ways of achieving this. The first one is to look at the actual VIX readings and try to determine when it is about to peak or bottom. The problem with this approach is that, although in the long run the index moves within a well-defined range, there is no telling in advance at precisely what level the reversal will take place. The other option is to apply different technical indicators to the VIX in order to determine when it's reaching overbought or oversold levels. Systems in this group are centered around the use of the RSI, moving averages of varying length, MACD, DMI, Bollinger Bands, Williams %R, and so on. The VIX Market Timing Module introduces a new approach. We apply a pivot moving average, PMA, which we'll discuss later on in this presentation, to both the VIX and the SPX, and monitor whether the indices cross or trade above or below the pivot moving average. Under normal conditions, one would expect the indices to trade on opposite sides of the average. When they trade on the same side of the PMA, that usually is an early warning signal that the trend is about to change. From a practical point of view, however, we've noticed that rushing to react merely because the indices are suddenly trading on the same side of the average can lead to frequent whipsaws. Therefore, we've included two signal lines in our module. The signal line at the bottom of the top chart turns green when VIX is trading below, and the SPX is trading above the PMA. The line turns red when the opposite occurs. In other words, when VIX trades above and SPX trades below the PMA. If the indices trade on the same side of the PMA, the current signal remains in effect until reversed. The signal line in the bottom, second chart, turns yellow when the indices trade on the same side of the PMA. As explained above, this could be an early warning signal that the trend is about to change, but could lead to frequent whipsaws as well. Therefore, user discretion is advised. Now let's proceed with a brief case study in order to evaluate the effectiveness of this approach. The SPX-VIX pair gave a sell signal for the SPX on Monday, September 23rd. The NDX QQV, QQQ-VIX, QQQ-QQV pair remained on a buy signal until Friday, September 27th. Then, both pairs remained on a sell signal, despite the spike up on Tuesday, October 1st, and the fact that the Qs reached a new high. As of this writing, October 9th, the SPX has lost some 50 plus points, while the NDX dropped 100 plus points. The second item for discussion is the OT Pivots app. Developed at the request of our users, it combines the power of pivot lines with cycles and several other new tools developed on the basis of pivot lines in order to provide a unique perspective on stock and index trading. Pivot lines are a simple but effective tool developed by floor traders in order to quickly and objectively identify intraday support and resistance levels. They can be used by range, breakout, and trend traders alike, and can be applied along with any other technical analysis tool or indicator. There are 4 main ways to calculate pivot points, and they are all available from the app: Standard, Woody, Fibonacci, and Camarilla. In addition to the 4 pivot point calculations, the app includes our proprietary pivot moving average. The PMA smooths out price fluctuations, defines areas of possible support and resistance, and helps visualize the trend. Changing the setting for the PMA affects the frequency of the trading signals generated by the app. The other 2 indicators included in the app are the pivot oscillator and the cycle bars. The pivot oscillator helps identify overbought and oversold levels and plays a role in generating the trading signals. The cycle bars are a dynamic cycle indicator which extracts the dominant short and medium cycles and plots them in the future, alerting ahead of time for potential change in trend dates. The PMA and the pivot oscillator are combined in such a way as to produce 3 sets of trading signals. The top signals, green and red triangles, are generated on the basis of the price crossing above or below the pivot moving average. The bottom signals, green and red triangles, are generated on the basis of the pivot oscillator crossing above or below the 0 line. The signals in the middle, green or red bar, are activated when the top and bottom signals are in agreement. In summary, OT Pivots provides users with easy access to pivot points and several trading strategies in a very affordable package. This concludes my brief introduction to the newest additions to the Odds Trader app family. If you haven't watched my first Traders World presentation introducing the original members of the Odds Trader app group, keep watching.